So hello students, today we will be starting a new chapter of partnership. That is chapter number 3, change in PSR. So change in profit sharing ratio. So after getting the understanding about the fundamentals of partnership, goodwill, now we will be seeing how the change in PSR will affect the accounting of the partners. So change in PSR is also known as reconstitution. So it can be called as the reconstitution of partnership firm. And the learning objective of this chapter will be that now we will be able to learn how the adjustment, how the reserves, how the accumulated profits, how the accumulated losses, purchase goodwill, self-generated goodwill will be adjusted in the books of the partnership firm among the sacrificing partners, old partners, gaining partners, and etc. So the learning objective is understanding the adjustment of goodwill that we have studied in chapter number 2. Understanding of treatment of reserves, profit and loss account, and advertisement suspense or any other fictitious asset. So to understand this, first of all we will know what is reconstitution. So for any reason, if there is a change in profit sharing ratio in the partnership firm, we can call it a reconstitution. What are the cases when we call a firm to be reconstituted? Number one, it can be a mutual change in profit sharing ratio between partners. Like the old partners had the ratio of 3:2, and now the partners want to change the ratio to 2:1. Or if they had an equal ratio, now they want to change the ratio to something 4:1 or any other ratio. So if there is a mutual change in ratio also, we call it a reconstitution. Number two, it can be due to admission of a new partner. Say a new partner is admitted, so it is surely that the partner's profit sharing ratio will be changed. Number three, it can be retirement of a partner. Number four, it can be due to death of a partner. But in case number 3 and 4, we have to make sure that the partnership firm still exists. Say if there are two partners having a ratio of 3:1 and one of the partner dies or one of the partner retires, we cannot call it to be a reconstitution, because in case of reconstitution, the firm has to continue. It can be called as a reconstitution even in this case if they arrange a new partner, if they can manage to get a new partner admitted. But if there are only two partners and one partner exists from the firm due to death or retirement, we cannot call it a reconstitution, we have to call it a dissolution. For that we have a separate chapter at the end of this book. So we can call it a reconstitution if there are three partners or more than three partners and one of the partner retires or death, we can still call it a reconstitution or death, because the ratio between the parties will be changing. Now what are the effects, what are the adjustments we need to do in case of reconstitution? We will be taking with an example of any one of the cases. Let's take an example of admission so that we can understand what are the effects, what are the changes, what are the adjustments we need to make in case of reconstitution. Let's suppose we are taking an example of a firm having partners A and B, and we are making a dummy balance sheet with some figures. So this is the balance sheet of an old firm as on 31st March 2023 of partner A and B. Say the capitals were 1,50,000 each. So 1,50,000, total being 1,50,000. They had reserves in their balance sheet of rupees 50,000. They have creditors of rupees 30,000. They have say outstanding expenses of rupees 10,000. Now coming to asset side, there are some fixed assets, so it can be tangible fixed assets. Tangible fixed asset, I am taking one or two examples so that we can understand some more concepts also. Say we have a plant and machinery at a value of rupees 80,000. We have a land purchase at rupees 50,000. We have patents under intangible asset. Under intangible fixed asset, we have say patents of rupees 10,000. We have an old goodwill, that is the purchase goodwill in the books, say at rupees 10,000 again. And we have some other current assets like debtors, stock, cash, and other things. So, say other current assets is 40,000 and advertisement expenses is 50,000. So, we have a balance sheet of 2,40,000 in total. The old partners are having capital of 1,50,000, reserves of rupees 50,000, creditors of rupees 30,000, outstanding expenses. On the asset side, they are having plant and machinery, land, intangible assets, say example patents, goodwill, some other current assets including debtors, stock, cash, bank, and advertisements. Now, what are the adjustments we need to do when there is a reconstitution? Now, let's take an example. Say they want to admit a new partner C. So, what do we expect a new partner? What do we expect them, or what do we expect C to bring in to become a partner? So, we naturally know that to become a new partner or to become an owner of the business, to become a partner, C has to naturally bring capital contribution in the firm. So, how do we calculate the capital contribution? So basically this is calculated number one on the basis of the profit sharing ratio that C will be getting from the firm. Second is this profit sharing ratio will be multiplied with the amount of value of the firm existing with A and B. So A and B's value of the firm will be calculated on the basis of latest values of balance sheet. All the assets and liabilities will be properly valued on as of today when the C is admitted to the firm. Then it will be calculated on the basis of C's share, like if he is getting 1/4 share and the value of the firm is coming to the market value of the firm is coming to 2 lakhs, then the new partner has to bring in 50,000 as his capital. Now you will be able to see that the value of the firm is either it is 2 lakhs if we see the capital approach or the liability approach, it is 1,50,000 plus 50,000, or if we see the asset approach, it is assets minus liabilities. But some other things are also there like advertisement, suspense is there, goodwill is there, which needs to be adjusted to calculate the correct capital employed. So before doing that, what do we expect? See, you assume yourself to be C. You will be understanding this chapter better if you assume yourself either to be A and B or you assume yourself to be C. Say, let's suppose you are A and B and I am a new partner C. This is your old balance sheet. Are you ready to admit me as a partner in this situation? This is your balance sheet. You are having reserves, you are having goodwill, you are having advertisement suspense. Are you ready to admit me as a partner? I am a new partner who is willing to get admitted to your firm. Are you willing me to admit in your firm? See the balance sheet, see the condition of a balance sheet. Is this the condition that you want me to enter? Certainly not. Because you have a reserves in the firm which is owned by you actually. You are A and B. Assume yourself to be A and B and old partner. So this reserve belongs to you. Because some years back when you are distributing the profit, say suppose you are having a profit of 1 lakh, but you did not want to distribute the entire 1 lakh as profit. So what the partners do generally, they set aside some amount like 10,000, 20,000, 30,000 as reserves for future uncertainties. So you as A and B, partners as A and B, they have set aside some amount that is 50,000 in the past years. It can be accumulative effect of a few years, that 10,000, 20,000, you had accumulated a 50,000 rupees. So before admitting C into the partnership, what A and B would expect, what A and B would like to do, they would like to distribute this reserve among themselves. Because if they don't do so, then what will happen? See, if they admit C in the same condition, if C enters into the firm and later on, after 1 year or after 2 years, when they decide that they want to distribute this reserve will be distributed among A, B and C because it will be distributed to all the partners. So before admitting a new partner or before changing the profit sharing ratio in any case, whether it is a retirement, whether it is death, whether it is mutual change, whether it is admission. So admission we have taken an example so that for a better understanding you will be getting, because a new member is coming into the firm. So you are A and B. Before admitting C, what you will want, what you will expect, that this reserve goes to A and B in their old ratio, because this was made from their profit, which they have earned from the business, not C. C does not own any part of this reserve, because this is the amount set aside from the profit which was earned by A and B. So what will they want? They will want to transfer these reserves to themselves. So write the first note, that is number 1, that reserves or any accumulated profits, that is number 1, reserves or any accumulated profits appearing in the balance sheet, reserves or any accumulated profit appearing in the balance sheet will be transferred to old partners. So in case of admission, we can call them as old partners normally, or in case of mutual change in PSR, we can call them normally partners. But reserves and accumulated profits will be transferred to old partners in their old PSR. This is to be considered, that is old PSR. Because this reserve was made from their old profits. That was, if reserves were not made, then these profits would have been distributed to them in their old PSR. So reserves or accumulated profit, this is the first adjustment that we need to make in case of any reconstitution. So number 1 is old reserves and old accumulated profits are to be transferred to old partners and in their old reserves. Now, what we have done, we have transferred this reserve from the balance sheet, and this is added to the capital of A and B. Done. Now think about the balance sheet again. Will you want C to enter into the firm in this situation? The problem was with the reserve, we have transferred it. Now A and B would not have any problem, but now problem is with the C. See, as I am coming to the firm, I will look at the balance sheet of this firm. I am seeing that there are some losses in the firm which should have been distributed to old partners. Because I as a new partner does not have any share in the profits, so I should not get any losses also of the old partners. Like we are having 2 items here. Number 1 is advertisement suspense. If we had profit and loss debit balance also, we call it an accumulated loss. This item also. So if we have P&L debit balance, if we have advertisement suspense, if we have goodwill also here, if goodwill is appearing in the balance sheet, it is, and no market value is given, we assume it to be valueless. So if the goodwill is in the balance sheet and no market value is given, if the market value is not mentioned, we have to assume it to be valueless. So if it is valueless and if the intangible assets are to be written off, it is a case of amortization, and amortization is a loss. So these 3 losses, we are not having P&L debit balance in this question, so we are not talking about here, we will need to write it in notes. But goodwill and advertisement suspense, these are the losses of old partners, which she as a new partner would not like to bear. So write the second point. Old losses, fictitious asset, old losses are to be transferred to old losses. You can write it as accumulated losses also, like P&L debit balance. So old losses, fictitious assets are to be transferred to old partners again, because this is the loss of old partners, that is A and B in this case. So old partners in their old ratio. If it is a mutual change in PSR, then this loss has to be borne by the partners in their old ratio. So we are calling it old partners in their old ratio. Point number 3 that we have already discussed here, we need to write the note. Number 3 is goodwill appearing in the balance sheet. Goodwill that is appearing in the balance sheet. So we are talking about the purchase goodwill here, the goodwill which is appearing in the balance sheet. We are not talking about self-generated till now. We will be talking about that again. So goodwill appearing in the balance sheet is to be transferred to old partners in their old ratio. We can call it written off. Goodwill appearing in the balance sheet is to be written off to the old partners in their old ratio. These are 3 points. So we have brought the balance sheet. So we have removed all the losses, gains from the balance sheet. Now what else? Now see the balance sheet. There are no reserves, no accumulated profits, no accumulated gains, no purchase goodwill which is valueless as of now. But is there any other adjustment to be made? Now if you see the balance sheet directly, you will see there is no other adjustment, there is no problem in admitting a new partner, but still there is a problem. What is the problem here? Say we have a land in the balance sheet, we have a plant and machinery in the balance sheet, we must have stock in the balance sheet. All these assets, we know as per historical cost concept, assets are to be recorded in the books at their historical cost, that is at their purchase price. Now let's take an example. Say we have purchased this land on 1/4/2020, that is 3 years ago. Now we are doing the balance sheet of 31st March 2023. Suppose we have purchased this land 3 years ago on 1/4/2020 at rupees 50,000, and still it is appearing at 50,000 because depreciation is not charged on land and it is recorded at its historical price. Now suppose on 31st March 2023 the market value of land becomes 1,50,000. We are not here to record the asset at its market price. Also, we are not here to we are not wanting to sell the land. But still, if the land is valuing rupees 1,50,000 in the market, so we have a gain of rupees 1 lakh. Because if we sell the land today, we will have a gain of 1 lakh. But certainly we don't want to sell it today. So what will happen if we don't change the value of this land? The market value is 1,50,000. But the book value is 50,000 because we have purchased this land 3 years ago at rupees 50,000. Now what will happen if we don't revalue this asset? If we don't change the value of this land, what will happen? Suppose we are admitting C in this situation of the firm. We have already transferred the reserve, we have already transferred the losses. Now we are, without adjusting the value of reserve, assets and liabilities, we are admitting new partner, or we are doing the formalities of change in PSR or the reconstitution. Now as this new partner enters into the firm, now after 1 or 2 months or just after admission, C, the new partner, gives suggestion to the old partners that we don't want land in our business. This amount is extra invested in our business. We already have plant and machinery to run our factory. So this land is extra investment for our business. So better investment, better returns we can get if we invest in stock. So if we liquidate this money, if we can sell this land and get that money and invest it in our working capital like stock and debtor, we will earn extra money. So say A and B are convinced. Now what will happen if A and B are convinced this land will be sold? Now what is the value that they will be getting if they sell this land? They will be getting 1,50,000. So what is the profit now? There is 1 lakh of profit on selling of land. This 1 lakh profit on sale of land will go to A, B and C because they are the current partners. Now you think yourself, should she get this profit? Is this the amount? Should this profit go to C also? No. Because the profit which was accrued in the past 3 years should have been transferred to only A and B. But without doing the adjustment, we are admitting C as a partner. Now entire profit, or even it is a loss, it will go to C also. So to avoid this type of any extra gain to a new partner or any extra gain to any partner, what we should do? We should revalue the assets. Similarly, say plant and machinery is at 80,000. But the market value, because this value is after depreciating the asset. So say market value of this plant and machine is 50,000. Without adjusting the values, we are admitting a new partner. And after admission, now the partners want to change the machinery. They want to purchase a new technology machine. Now they want to sell this machine for rupees 50,000 because that is the market value. There will be a loss of 30,000. This loss has to be borne by all the partners, which is again not fair because this loss was already known when the partners were when A and B were the partners. Before entering C as a partner, the loss of 30,000 was already known to them. Just it was not realized because they did not want to sell it. Because the partner did not want to sell it at that point of time, this loss was not realized. After admitting C, when they are selling this asset, they are getting a loss of 30,000. Now the loss of 30,000 has to be borne by A, B and C, all the partners. Is it fair? Not enough. Because C is a new partner who was not there when the value of land was or value of the plant and machinery was decreased. So what we should do, we should revalue the assets and make it and bring it to its current value, and any loss or gain coming out of it should be transferred to again old partners in their old ratio, because that time the partners were A and B. So that profit or loss should be transferred to A and B. Also we can take example of a liability. Suppose there is a contingent liability, say. Then what is contingent liability? If you can recall, contingent liability means such liability which are not recorded in the books because they are not, maybe the chances are low or the amount is not exactly known. So contingent liability are liabilities which may or may not be paid in future, which depend upon future uncertain event. So this is not recorded in the books because maybe the liability of paying that amount is less, or the amount is not estimated, or amount is not 100% known. Now, before admitting C, we should reassess the liabilities. We should like we revalued the assets, similarly we should reassess the liabilities, whether there is an extra liability coming for the firm, or whether any liability appearing in the books are at their real value or not, are at their payable value or not. Suppose our creditors are 30,000, but the real payable value is only 25,000. There are some creditors which are not traceable, so we are not liable to pay them. So this gain of 5,000, if you are not liable to pay some amount, this gain should also go to the old partners. Or if there is any additional liability, this should also be borne by the old partners. So write the fourth point. So first point was that all the accumulated profits reserves should be transferred to old partners in their old ratio. Second point was all the accumulated losses, fictitious assets should be transferred to old partners in their old ratio. Third was goodwill appearing in the balance sheet should be written off, and the loss should be transferred. Again, the loss accruing out of it should be transferred to old partners in their old ratio. Number 4, at the fourth point, that is the fourth adjustment of reconstitution. Assets and liabilities are to be revalued. Assets and liabilities should be revalued and reassessed. So basically for asset we call it revalue, and for liabilities we call it reassessed, but we can call it revalue also. So assets and liabilities are to be revalued and reassessed through a nominal account called revaluation account. So we will use a nominal account, a separate account, a nominal account which can also be called as profit and loss adjustment account. So assets and liabilities are to be revalued and reassessed through a nominal account called revaluation account or profit and loss adjustment account, and profit or loss on such revaluation and profit or loss on such revaluation should be transferred to old partners in their old ratio again. So till now all the amount that we have calculated, all the adjustment that we have done, were all talking about the past profits and past losses. Reserves were created out of past profits. PL accumulated balance is again a past profit. PL debit balance is again a past loss. Accumulated fictitious asset is again a past loss. Goodwill appearing in the balance sheet is again a loss of the past. Revaluation gain or loss is again of the past. So all these past profits and losses are transferred to old partners in their old ratio. Now, talking about the next point. After cleaning all the balance sheet, cleaning means in terms of all the making it fair, making all the fair value, bringing it at the fair values. So all the assets and liabilities are now at its fair value. That is the market value, we can say. So plant and machinery is revalued at 50,000 as we said in our previous example. Land is now revalued at 1,50,000 as we said. Patents there is no change, so it will be at the same value. Debtors there may be change, that there may be some provision for doubtful debt. We may have doubt on some debtors, so we can make provision for doubtful debt. Stocks may be revalued as per the current real stocks. Creditors may be revalued, just as we had a talk, like we can make revalue to 25,000 because creditors of rupees 5,000 are not traceable. Similarly, a contingent liability which is now confirmed that has to be paid, it can be brought in here. So outstanding expenses, there is no change. So all the assets and liabilities are now at their fair values. Now what else? Now we can bring in C. C will be observing all the things, how we'll calculate, he will also participate, and A or B will also participate in calculating the capital employed of the old firm. They will be calculating the capital employed either by the asset approach that we have seen in chapter number 2, goodwill, that is assets minus outside liability. Now there is no fictitious asset, no losses, no reserves, so assets minus liability will give you capital employed, or even you can do the total of the capitals, that will also give you capital employed. Now after calculating this capital employed and multiplying it with the share of new partner, we can get the capital contribution of a new partner, what we expect the new partner to bring in. This is one part of a new partner that has to bring, that is the capital contribution. Is the new partner required to bring anything else? Yes. There is some assets. There are some assets, or there is one asset which is not visible here. That is certainly self-generated goodwill. Self-generated goodwill is not appearing in the books because as per accounting standard 26, we know, as we have studied in chapter number 2, all the goodwill that we have calculated there were as per AS 26, and that were self-generated goodwill. Those are goodwill which are assets for a firm. What does a goodwill do? We have to understand this to do the adjustment. A goodwill brings extra customers for the business. A goodwill gives you extra profit in the future. A goodwill, what a goodwill does for a firm, goodwill helps you to earn some extra amount in the future over and above the normal profit. See, a normal profit can be earned by the business out of its capital, because that is the investment. Any businessman without any goodwill in the market also will earn. Say if we see any businessman, say if a new businessman opens a sweet shop or a clothes shop, he will also earn. Any business which is opened in the market, they will earn. But they certainly earn the normal profit which that type of industry is earning in the market. But your firm will earn some extra profit because you have goodwill in the market. Because why the new partner is interested to enter into your firm? Why is not wanting to open a new firm? Because he already knows that your firm is having a good standing in the market. Your firm is having a goodwill in the market. So he is thinking, the new partner is thinking that yes, I can do something good with the experience of A and B, and also I can help them in developing the business further. Now, this goodwill helps this firm to earn profit in the future. The problem is we cannot distribute this amount to the old partners today, because other amounts that we have calculated now, like we revalue the assets and liabilities, we transfer the old reserves, we transfer the old losses, but this cannot be done with the goodwill. Why it cannot be done? Because all these items were the past profits and past losses. But now we are talking about goodwill, which will help you to earn extra profit in future, but not today. That profit cannot be earned today, because that goodwill, your name in the market, your fame in the market will give you extra profit in future, not today. Now, who owns this goodwill? Who has made this goodwill? This goodwill is made, this goodwill is owned, or this goodwill is earned by A and B. This goodwill is created by A and B, that is the old partner. They have done all the hard work and they have made this goodwill out of their good service in the market. These are the factors of goodwill. We know that out of their good service in the market, out of the services they have provided, good quality products they have provided, out of the good customer relationship they have maintained, they have made this goodwill. Now this goodwill, the benefit of this goodwill should be transferred to A and B only, because they have earned this goodwill. But if we admit a new partner, or if we change the PSR, obviously that the goodwill will be distributed in future, because goodwill will give you profit in future only. It cannot give you profit today. Goodwill will give you profit in the future, which will certainly be distributed to the new partners. Now, how to adjust this? Because this goodwill should have been distributed to the old partners, but since this goodwill will give you profit in future, this will go to the new partner. So what can be done? So who is actually earning out of this? Who is actually earning out of this? Because this goodwill will be transferred in future. So who will earn out of this? Is this the new partner? Okay, yes, but it is partially true. Not only new partner will earn out of this, also a gaining partner. If you call it a gaining partner, it will be better, because it can also happen that an old partner gains. Let's take an example. Normally what happens, if this is the case, that the old ratio was 3:1, that is 75% is owned by A and 25% is owned by B. Now, if a new partner is admitted, let's say like this 3:1:1, this is the new ratio, then what will happen? The ratio is 60:20:20. Then who is gaining here? The partner A is gaining, partner C is gaining here. There was no share of C in the old firm. Now what is the ratio of C? That's 20%. What is the new ratio of B? It is 20%. Earlier it was 25%. So obviously the old partner is sacrificing, and also A is sacrificing. So A is also sacrificing 15%, B is sacrificing 5%, and both of them are giving share to the new partner, and then partner is gaining 20%. So A is sacrificing 15% from his share, B is sacrificing 5% from his share, and C is gaining 20%. Obviously, who will gain in future? C, because he will be getting extra 25%, which should have been given to A and B. Who will sacrifice here? A and B. But can the case be different? Yes. If the old ratio was 75:25, that is 75% and 25%, that is 3:1, and the new share is 50, 30 and 20. If say this is the new ratio 5:3:2, now what will happen? A is sacrificing by 25%. Now we will be getting 30% in the firm. even after admitting a new partner, an old partner is gaining. Is it possible? Yes. So it all depends upon how we decide the new profit sharing ratio, how we decide the new structure of the firm. It will all depend on that. So how will the goodwill be adjusted? Who is gaining out of this future distribution of extra profit? The goodwill which we have earned today, the goodwill which we are having today, we are talking about the self-generated goodwill which is not appearing in the balance sheet, of course. So who will gain out of this self-generated goodwill? The gain will be coming to gaining partners. Who are not only the new partner, but who is gaining here? The gaining partners. Gaining partners will gain and sacrificing partners will lose. So how we can adjust the goodwill? So the fifth adjustment for the reconstitution. So the self-generated goodwill is to be calculated. So adjustment number 5 is self-generated goodwill is to be calculated. Self-generated goodwill is to be calculated, and the adjustment is to be made as follows. Self-generated goodwill is to be calculated, and the adjustment is to be made as follows. So we have to take money from the gaining partner and give it to the sacrificing partner. There are some conditions. If the new partner is not bringing goodwill, we will take it from current account. If the new partner is coming in, he has to bring goodwill in cash. If the old partner is gaining, we have to take goodwill from the capital account. Those all we will be doing in further topics. We have separate topics for that. But now you can write in simple, in a normal term, that is gaining partner's capital account debit. And obviously we know if it is a fixed capital account, we will be taking from the fixed capital. If they are maintaining, we will take it from the current account. So we can do it in details as taking the examples, but normally we can write that we will take it from gaining partner and we have to give it to the sacrificing partner, because the partner who is gaining the extra amount, we will take it from him and we will compensate the loss of the sacrificing partner. So the entry will be gaining partner's capital account debit to sacrificing partners. So some other adjustments are also there. We'll be continuing that in the later classes. Like what if they want to retain the reserves? Like if the partner decide not to transfer the reserves, what is the adjustment? Yes, we have to see that. So what if they don't want to revalue the assets? Because if we revalue the asset, there is one problem, that we are not in conformation with the historical cost concept. So if you are violating the historical cost concept, so if you don't want to violate it, if you don't want to change the value of assets and liabilities, is there any provision? Yes, we do have a provision. So we will be discussing in the later classes. Thank you so much.